Welcome to Retirement Crusaders. Today we will talk about real estate investment trusts and why they are so appropriate for retired investors. Now, real estate investment trusts are entities that do not have to pay any taxes. So unlike a corporation that earns income and then has to pay taxes on it, and after the taxes has money to distribute to you, the shareholder, the real estate investment trust doesn't pay any taxes so long as they distribute 90% of their net income to the shareholders. And that's why they pay such high dividends, because they are distributing most of their income. Now, there's two other advantages to real estate investment trusts. Secondly, real estate has appreciated over time. So in addition to a healthy dividend, you can hopefully get some growth in your capital. And then third, it's liquid. So unlike if you owned an apartment building yourself and you went to sell it, you get a broker, they put it on the market, it takes 5 months to find a buyer, he's got to get financing, etc. With a real estate investment trust, it's just like shares in any company or a mutual fund that you own. You want to sell it, you go online, you push a button, and you sell your shares, and you're done. So those are the advantages of real estate investment trusts and why they're so appropriate for retirees. Now, there are two types of real estate investment trusts. One are called, and real estate investment trusts, the abbreviation is REIT, REIT. So there's two types of REITs. One is mortgage REITs. Now, mortgage REITs are those that do not invest in property, they loan on property. So they buy mortgages, and those mortgages are obviously financing homes, let's say. In fact, two of the most popular REITs among retired investors are two REITs that invest in guaranteed mortgages. So these are mortgages that are guaranteed by a government-sponsored enterprise like Freddie Mac or Fannie Mae or Ginnie Mae, which simply means this: if Mr. Smith has a mortgage and he defaults and he stops making his payments, that government-sponsored enterprise will step in and make his payments and his principal repayment when the time comes. So you, as an investor in that type of mortgage or that type of REIT, you don't have to worry about the credit risk. There's no credit risk because of the guarantee. Now, of course, there's interest rate risk, which means as interest changes in the economy, the shares of the REIT are going to react to that. And so let me show you how that works. But first, let me show you how these mortgage REITs make their income. So here's how mortgage REITs are able to pay very healthy dividends, usually a minimum of 8%, sometimes as high as 14%. So the first thing is they have shareholders. So let's say you're a shareholder, you invest $1, and so now the REIT has $1 to work with. They then go out and they borrow money. So they borrow $5, and they have to pay interest on that, and let's just say the interest is 2%. So now they have $6 to invest in mortgages, and let's just say, for our example, they get 4% on the mortgages. So their income from the mortgages is the 4% of the $6 that they're able to loan out is 0.24, let's say 24 cents. They've got to pay interest, obviously, on that money they borrowed, which is 10 cents. So if we subtract the 10 from the 24, they're left with an income of 14 cents. Now, of course, the REIT has expenses. They've got, executives and people who actually run the REIT and do all the work. So they have to pay out some money for expenses. But after expenses, they're left with net income of 12% to distribute to the shareholders. So by using leverage, by borrowing money, they're able to invest more and get a double-digit return on the investor's capital and pay a very healthy dividend. Now, what I just showed you works very well in normal times. So this is what's called the yield curve. And the yield curve normally looks like this. Very short-term money is very cheap. You see, like a year ago, this is December of 2021, that a one-year treasury bill was yielding 0.25%. So this is why REITs are able to make money. They're able to borrow money cheaply because they borrow money short term, but then lend it out as 30-year mortgages so they can make more money. So they borrow short and make money by lending long, and they make what's called the spread. That's how they make profit, and they're able to pay those double-digit dividends. But sometimes things are a little different. Sometimes, like now, the yield curve looks like this. Right now, the short-term rates are somewhere up here, and the long-term rates are down here. So the problem is REITs can't profitably make money. Let me show you a chart of the spreads. Here we go. We can see from the third quarter of 2019, you can see this was a great period where their spreads were increasing, and here they're nice and fat. This is a great period for mortgage REITs. This is when they're paying big fat dividends out and making all kinds of money. And then you see what happens when the Fed decided to increase short-term interest rates. The spread practically disappears. Okay, so as a result, these are not good times to be invested in mortgage REITs. Here's a chart of Annaly Capital, which is one of these big mortgage REITs that invest in these government guaranteed or government sponsored enterprise guaranteed mortgages. And what you can see here is there's times when it's very, very good to be in these REITs, when the share price is appreciating and you're getting say a 10, 11, 12% dividend. So we see there's periods of time when it's very good. Now, this happens to be a snapshot of the current moment. Now, the yield right now is 16%. Why? Because the price is so depressed. Why is the price depressed? Because the yield curve is inverted, and these are not good times for real estate mortgage REITs. So therefore, there are times when it is not good to be an investor in these mortgage REITs. In other words, what I'm telling you is you can't buy and hold these for the long term. A lot of authors I see, financial raters will say, oh, these are great for retirement, just buy them and hold them. I don't think so. I think this will just destroy your capital over time. What I think is there's great times to be an investor, and how do you tell? Well, as I mentioned in previous videos, I use a service called Seeking Alpha. And on Seeking Alpha, there's a writer named Scott Kennedy. Now, Scott is a CPA, and he has all kinds of experience and credentials, and he does an enormously great job at tracking these REITs. And if you follow his articles, he will tell you, here's the time to get in and here's the time to get out. So you're able to get it, and he's been right 85, 90% of the time. So by using his tracking and his advice and his signals, he tells you when these are good to be in and good to be out. So that's my caution about mortgage REITs. Now, Seeking Alpha, I did a whole video on this service, my favorite investing service to research stocks and to find really good stocks for retirement. They have a special below in the description. I think it's normally something like $20 a month. You can get it for $39 for the entire year. And I think they're running that through January 3rd of 2023. So if you're watching this video in December of 2022, you can certainly take advantage of that really, really excellent price and grab yourself a subscription. Seeking Alpha does compensate Retirement Crusaders for any subscriptions, so just want you to know that, full disclosure. Now, by the way, just because this dividend is so high doesn't necessarily mean it will be cut. Remember something about dividend yields. Let's say you have a stock and the price is $100 and it pays a $5 dividend. That's a 5% yield. But if the stock price falls from 100 to 50, the yield is now 10%. Not because the dividend went up, but because the price went down. So 5 over 50 is 10%. So similarly here, it's not that these REITs have raised their dividends, it's just that their prices have gone down. You know, this REIT from 75 to 25 because it's in a very bad period here, you know, during this time period. So that's why the yield is very high, because the price is depressed. So it doesn't necessarily mean they'll need to cut this yield. How can you tell? Again, on Seeking Alpha, I follow Scott Kennedy. He will he can tell you, look, they're earning enough money to cover their dividend. Don't worry about it. They won't cut it. Or he'll tell you, no, they're running into headwinds. They've got to cut their dividend. And so you'll know almost always ahead of time when the dividend is suspect, when it's likely to be cut, or, you know, when the shares are likely to fall. So that's how I invest in mortgage REITs. I'm not a long-term holder. Just like with bond funds, you can't be a long-term holder of bond funds because over time they will decay your principal, similarly with mortgage REITs. Now, let's talk about the other type of REIT, equity REIT. These are REITs that go out and buy real estate. Make sure to hit the subscribe button and the bell icon below so you'll get notified of our next video. Now, equity REITs are kind of like Baskin-Robbins because there's lots of different flavors. If we look here on this table, you can see there's REITs that invest in self-storage properties, where you go and rent a space and put all your junk because we got too much junk in your garage, or net lease properties. These are a property, for example, like an owner of a McDonald's may not own the location. The REIT owns the location and he leases the property from the real estate investment trust. So that would be like a net lease property. Then there's REITs that own casino and gambling, or industrial warehouses, or apartments, or shopping centers, or cell towers that transmit the signals for your mobile phone. And so you see there's all kinds of different flavors of REITs. Okay, so you can, if you have a particular flavor that you really are enamored by, you can go easily do research on those types of REITs. So for example, I really like manufactured home REITs. Why? Because a company, a REIT, is able to buy land, buy manufactured homes, put them up on that land, and then either rent them out or sell them. And the beauty is that those homes sell for, say, $250,000 rather than more like $600,000 of a stick-built home in the same area. So these tend to be very recession resistant, and they're able to provide very, very affordable housing for people in all different types of economies. But you may decide, for example, that hotels were badly beaten during COVID. Maybe you think, hotels should really be coming back. I'm interested in hotel REITs. Well, how do you find out? Well, this is what I would do. I go to Seeking Alpha and I would type in hotel REITs. And now I have articles. This guy's talking about self-storage hotel. Let's see if I scroll down here. Hotel REITs lead U.S. REIT dividend hikes in November. Here we go, picking a winner in hotel REITs. So you'd read this author, and then you'd read hotel REITs winners coming. You'd read this author, and you'd have, probably 6 to 10 authors that are researching hotel REITs. You'd be able to read all the research and in less than an hour develop your own opinion of to which of these REITs look good to you. And you could do that with any of the REIT categories I showed you. Now, you might say, well, I don't know which REIT category would be good. What should I do? Well, this is what I do. On Seeking Alpha, I go over here. So let's see, this is my home page when I first log in. I would click here on my premium services, and then I scroll over here to top REITs. I would click this, and these are REITs that most of them have 3 green. Well, here's what that means. They're rated green for quantitative purposes. So this is a formula that Seeking Alpha has to determine the growth of the company, the valuation, other quantitative metrics, and rank them. So anything above 4 and above gets a green bar. These are the ratings, this column, of the Seeking Alpha authors. So all of the authors that are following this stock, Alpine Income, they have rated it cumulatively, or average of all of them, a 4.5 out of 5. So it gets a dark green. And then the Wall Street analysts, those that work for Merrill Lynch, Morgan Stanley, those big investment companies, they cumulatively together in aggregate have a 4.5% ranking out of 5. So it also gets a dark green. So that's what they mean by top REITs. And they have 25 REITs that are ranked. Not all of them have 3 green. Some have a hold rating on them. And you would come here, and I can click on this column, dividend yield, sort by dividends, and I could start here and just click on each one of these. CTO Realty, wow, that looks really good. It's got dark green, so it's got some really high ratings and a really attractive yield. You can see of the quantitative rankings, really good valuation, meaning the stock price is attractive relative to how much money this company earns. It's got a green for growth, profitability, so-so, green for momentum, meaning the recent stock price, and green for earnings per share. So if we click on this, we can see not only how this stock has done over time, but we can read all of the research from 1, 2, 3, 4, 5, 6, 7, 8, 9. So there's 10 different researchers who have written about this REIT, and you could read each of them. And again, in an hour, decide, well, does this make sense to invest in to get an 8% dividend and hopefully some appreciation, which would depend obviously on your opinion of what these authors are saying and what the outlook is for this particular REIT. So there you have it in a nutshell. These are the basics of mortgage REITs and equity REITs, where to start your research, and where to get some really high single-digit or even double-digit dividends. To make sure you get notified of additional educational videos to show you how to have a better retirement, make sure and hit the subscribe button below and the bell icon so that you'll get notified when we post a new video and you log on to YouTube. See you next time on Retirement Crusaders.